2022 was a challenging year for all asset classes, with all stock and bond indices finishing the year lower. Typically, prices for stocks and bonds have an inverse relationship, but last year, higher interest rates weighed on both stock prices and longer duration bonds. The NASDAQ index, which is comprised of mainly technology companies, fared the worst, down over 30% over the course of the year. The energy sector was the one bright spot, up over 60% in 2022. Much of this outperformance was a bounce from the lows reached during the pandemic. The sector benefited from higher energy demand as the world reopened. Supply was also disrupted by restrictions on Russian oil due to the war in Ukraine, causing energy prices to spike last spring. Value sectors such as energy, utilities, consumer staples, and healthcare held up much better than growth sectors like technology, consumer discretionary, and communication services. At the beginning of 2022, the S&P forward price-to-earnings ratio was about 21 times, rivaling the high valuations of the dot-com era. However, the 18% decline in the index alongside steady earnings brought this valuation metric down to about 16 times, in line with the average over the last 30 years. The latest data has shown that inflation is retreating from the multi-decade highs reached last year. The headline Consumer Price Index, or CPI, has come down faster than core CPI, which excludes volatile categories such as food and energy. Due to supply chain issues during the pandemic, prices spiked for used cars and trucks. The war in Ukraine also caused a dramatic upswing in energy prices early last year. However, prices for both have retreated quickly as supply chains have normalized and energy supply has come back online. Services inflation, however, has risen substantially and may prove to be stickier than goods inflation. One of the main drivers behind service price inflation is the extremely tight labor market. We have recovered all 20 million jobs that were lost during the pandemic, but there are still over 10 million job openings, which translates to about 1.7 jobs available for every job seeker. After coming to the realization that inflation was not, in fact, transitory, the Federal Reserve embarked on its most rapid rate hike cycle since the 1980s to try and restore price stability. The Fed made its first 0.25% rate hike in March, followed with a 0.5% increase in May, before getting serious with 4 back-to-back 0.75% increases. At their December meeting, they implemented another 0.5% rate hike. These rate increases took the lower bound rate from 0 at the start of the year to 4.25% by the end. The second main tool the Fed has to manage inflation is its balance sheet. Before the financial crisis in 2008, the Fed maintained a steady balance sheet level of just under $1 trillion. In the wake of the financial crisis, the Fed increased its balance sheet to about $4.5 trillion through 3 rounds of quantitative easing, or QE. When the pandemic hit in 2020, the Fed quickly doubled its balance sheet up to a peak of about $9 trillion. These asset purchases are the modern-day equivalent of printing money to stimulate the economy, a necessary measure through the financial crisis and the pandemic. Now that high inflation has become a problem, the Fed needs to wring money out of the system by reducing the size of its balance sheet, a process known as quantitative tightening, or QT. Since last April, the Fed has reduced its balance sheet by about $450 billion, and so far, we've not seen any major liquidity disruptions. However, this balance sheet reduction is something that we are tracking very closely. In the decade plus after the financial crisis, ultra-low or even negative real yields meant that bonds offered very little return opportunity. This gave rise to the TINA phenomenon, which stands for there is no alternative to equities. However, as rates have risen, real yields net of inflation expectations have increased to the highest level since 2009. Now, there is an alternative. While we are optimistic that we're past peak inflation, the tight labor market will likely keep service inflation sticky. As a result, the Fed's monetary policy will remain restrictive until the labor market softens. Market bottoms typically usher in a change in leadership among asset classes. The decade-long low interest rate environment is over, which will challenge growth equity valuations. We are pivoting to value stocks, adding exposure to relatively cheaper international equities, and looking to extend duration in fixed income.